Economies are always in motion. They go up and down. This is natural. Like the tides, there are periods of growth and periods of decline. We call these economic cycles. Understanding these cycles is key to navigating the financial landscape. Imagine a roller coaster. There are exhilarating highs. There are also stomach-churning lows. Economic history is full of these ups and downs. From the roaring 20s to the Great Depression, the ride can be wild. Why do economies experience these swings? There are many factors. Human behavior plays a big role. Fear and greed drive markets. Government policies also have a huge impact. By studying the past, we can learn to ride the waves of the future. We can prepare for the downturns, and we can make the most of the booms. The 1920s roared with prosperity. People felt invincible. They invested heavily in the stock market, but this exuberance masked underlying problems. Overproduction and speculation were rampant. In 1929, the stock market crashed. It was a black day for the American economy. Panic ensued. People rushed to withdraw their money from banks. Banks failed. Businesses shut down. Millions lost their jobs. Unemployment soared to unprecedented levels. Lines for bread became commonplace. The Dust Bowl added to the misery. This natural disaster devastated farmers, turning fertile land into barren wastelands. The government responded with the New Deal. This series of programs aimed to provide relief, recovery, and reform. It put people back to work, and it helped to rebuild the economy. The Great Depression was a time of immense hardship, but it also taught us valuable lessons about the importance of regulation, social safety nets, and responsible financial practices. After the devastation of World War II, the United States experienced an economic boom. Returning soldiers needed homes and jobs. Industries boomed to meet the demand. The American dream seemed within reach for many. New technologies emerged. Suburbs sprawled. The middle class expanded. It was a time of optimism and prosperity. However, this growth came with a price inflation. The demand for goods and services outstripped supply. Prices rose steadily throughout the 1960s. By the 1970s, inflation had become a major problem. The government tried various measures to combat inflation. They raised interest rates. They tried to control wages and prices. But inflation persisted, eroding purchasing power and creating economic uncertainty. The experience of the 1970s highlighted the complexities of managing economic growth. It underscored the delicate balance between stimulating the economy and keeping inflation in check. Section 4. The 2008 Crisis Houses of Cards. The early 21st century saw the rise of a new economic bubble, the housing bubble. Low interest rates and lax lending standards fueled a surge in home prices. People were encouraged to take on mortgages they could not afford. Wall Street got in on the action. They bundled these risky mortgages into complex financial instruments. These instruments were then sold to investors worldwide. Few understood the risks involved. When the housing bubble burst, the financial system went into a tailspin. Home prices plummeted, mortgages went into default, banks faced massive losses. The government responded with unprecedented bailouts. They pumped trillions of dollars into the financial system to prevent a complete collapse. The crisis triggered a global recession. Millions lost their jobs and homes. The 2008 crisis exposed the dangers of unregulated financial markets and the interconnectedness of the global economy. It served as a stark reminder of the devastating consequences of reckless lending and borrowing. Section 5. Lessons from the Past, Eyes on the Future. Economic history is a chronicle of booms and busts. From the Great Depression to the 2008 financial crisis, each downturn has taught us valuable lessons. We have learned the importance of regulation. We have seen the need for social safety nets. And we have witnessed the devastating effects of unchecked greed and speculation. Looking ahead, we face new economic challenges. Technological disruption is changing the nature of work. Climate change poses significant risks, and global inequality continues to widen. By heeding the lessons of the past, we can better prepare for the future. We must promote sustainable economic practices. We must invest in education and innovation, and we must work together to address the challenges of our time. The economic roller coaster will continue to rise and fall, but by understanding the forces at play, we can strive to create a more stable and prosperous future for all.